So we're going to kick off with one of the most distinctive strategies in the Nedgroup investments range. That's the Bravata Worldwide Flexible Fund. Now, this fund is designed to give you inflation plus 5% over time with the freedom to allocate across regions, countries, asset classes, and obviously to hold cash as well, with a very strong focus on downside protection. Now, joining me is Walter Aylett. He's a portfolio manager and founder at Aylett & Company. Walter, it's great having you here. Thank you so much for joining me.
Thank you.
So Walter, I guess before we unpack what happened over the quarter, can you briefly explain the philosophy behind Bravata? Like, what are you thinking when you manage the fund, and why is the strategy so different from like your typical balanced or flexible fund?
Well, I think you said it in the introduction, in that it has this wonderful privilege of being quite unfettered in its thinking. It can go anywhere, invest in any asset, in any market. And we've probably done all of that. So at one stage in its life, we were very big in Japan. For the first time, we went into bonds, not aggressively, but we did go into bonds in South Africa. And we even own property today, whereas before in the past, we didn't own property. And there's a natural bias for most fund managers to always be equity focused. And we are trying to get away from that. You know, the ideal thing is to have 10 investments totally uncorrelated to each other. And that's what you'll get in this portfolio, or its mandate. So that's the first thing. And the second thing is the type of clients that are in this fund are very much in sync with us. And so they've been with us from day one. And when you manage money with such a long-term perspective, it gives you a huge advantage. And that's why you get those returns.
I definitely want to dig a bit deeper into that. And I like how you mentioned about moving away from equity as well. We'll talk about that just now. But I think for today, we'll definitely talk about performance. We'll talk about your asset allocation, some of the contributors and detractors, your outlook as well. So I think it's going to be a very interesting presentation.
Sure.
So Walter, I guess if you look at the longer term numbers, then you've done so well against inflation plus 5. And since inception, if you look at it, meaningfully you've outperformed. You've navigated multiple crises, market cycles, and valuation extremes as well along the way. I mean, it's obviously not an easy thing to do. And particularly what is impressive, as you mentioned about the equity exposure, you haven't relied on excessive equity exposure to do that, which I think is fantastic. So what would you say are some of the key ingredients in delivering this long-term outperformance for clients while still protecting capital along the way?
Thank you. That's very kind of you. But the truth is that what really has been the secret behind success, first, are those clients. They've been with us from day one, so they allow you to take quite a long-term view on the asset that you purchase, and you don't have that short-term focus in your thinking. Secondly, because you have this opportunity to invest all over the world, you get this uncorrelated return. So buying a chocolate company in Indonesia is going to be different to a chocolate company, say, in South Africa, if you can, or in Switzerland. Valuation and all that. And that's exactly what's happening in the fund. There's a little chocolate company in Indonesia that's doing really well for us. And so we were able to choose in many, many assets all over the world. And then thirdly, we took quite big positions in, say, a company like Berkshire Hathaway, which we have owned for 15, 16 years. We've just recently sold it about a year and a half back. Not many funds do that. And so you leave the roses in the fund and you hopefully pick out the weeds, and I think that's been part of it. And just being patient. People, a lot of investors say they're patient, but they're not. The turnover in this fund is less than 8%. And when you get such high interest rates as we had with the bond market in South Africa, even now you're getting on 5-year money, you can get 8.5, 8%. It's not bad, and that's sovereign paper. So it's risk-free. I think I'm quite comfortable as long as inflation doesn't get out of hand. You can just sit back and enjoy that very slow compound. You need patience, and that's what's been behind the fund. And when you look at these returns, what's important to remember is that we've had a lot of headwinds the last 4 or 5 years. The rand has strengthened. It hurts. When you hold cash, it does hurt you a bit, particularly when you've sold something, now you're waiting for the next opportunity. You do bring it back to invest when you find an opportunity in South Africa. And so I think it's also this willingness to invest back in South Africa. A lot of fund managers have this bias towards offshore, offshore, offshore. We don't have that bias. We just try and do, and then finally it's that common sense approach. If you're just rational in your thinking and you're patient, and then the market provides you that wonderful opportunity, like in 2008, 2050 with the commodity crisis that we had. I don't know if you remember, Anglos went to $50.
Anglos almost went bust,
yes,
right?
Yes.
Back then.
And I remember clients phoning saying, it's going to go bust, what are you doing there? And we were just piling in. And then, of course, COVID was magnificent for us because we had the cash. A lot of fund managers don't like owning cash. We love cash in the sense it gives you optionality. And if you're getting 7% or 8% weighting, that optionality is almost for free. Because if you're fully invested, you've got to go and sell a share to buy another share. And when the market corrects, it goes all down, everything goes down. So then you're selling a great asset for less and buying a better asset for less money. So sometimes having cash is good. Powder in the corner, dry powder.
Yeah, I mean, there's actually many points that you brought up now, like your buy-sell discipline, holding cash, the dry powder aspect, market correlations, and trying to navigate through that. I definitely want to dig into those things a bit later on as well.
Yeah, I think the one thing that until recently we didn't make many mistakes in this fund. There are very few. Only recently we made one or two errors of commission, as I call it, and that has been disappointing. But you learn from it. You will make these mistakes. But in general, we've avoided losing money.
No, definitely. I mean, it definitely shows in your performance numbers as well, where you've been so consistent. I mean, that's actually quite rare in the kind of flexible space to be performing so consistently versus benchmarks. But the question I want to ask you is that, and you kind of alluded to it already, but in terms of your valuation discipline, how important has that been in achieving these outcomes, particularly when markets get super excited?
Well, it's very easy to buy anything. Anyone can buy anything, but the discipline comes in first in understanding what you're buying, and that takes hard work and takes time. And you to really understand the economics of the asset that you're looking at. Once you get that all under your belt, it's now what's that worth? And the calculation is fairly simple, especially if you're long-term in your thinking. And if you beat the risk-free rate, and the managers of that asset invest the free cash flow of that asset in a rational manner, you will beat the bond market, which is what the benchmark is in terms of risk. So if you overpaying for an asset is a problem, because once you write the check out, the return is determined. So we don't want to overpay. And for that, sometimes we pay errors of omission. There are very many ideas that we've missed because we've been a bit too focused on not overpaying. And that's just who we are. So we are going to miss the apples. We're going, and maybe we bought BHP instead, which was just as good when the commodity boom happened in the late 90s. But that's just who we are, and we can't change that. What we can do is be more focused, which I think we're busy doing right now.
We'll definitely talk about that just now as well. And I think you have two of the reasons why we actually love you. So yeah, just keep at it. Great.
Thank you.
And Walter, I guess if you look at your contributors and detractors, right, kind of a variety of stocks that have performed well and badly and contributing to performance. But what I want to ask you was that when you look at, let's say, temporary headwinds, like how do you distinguish between what's temporary and, let's say, a real structural deterioration in a company when you decide, okay, well, I want to allocate more money, for example?
That's a great question. Probably one of the better questions I've heard in a long time. I kind of start every now and again with a blank piece of paper. And I think, what would I invest in if I had started a new fund or a new business or a new portfolio? And I put those ideas on the paper. And if those ideas are not in the present fund, then there's something quite wrong there. And I think typically you've got to admit to yourself that there's a mistake. And if you have too many assets in your fund, you won't pick it up because there'll be 30, 40 counters there. But if you only got 20, maybe 15, you're quite focused. Like if you look at the top 10 shares make up 50% of the fund, you're going to know those 10 stories very, very well. And hopefully you'll pick it up there. I think the most important thing is not to be distracted by short-term volatility, like what we're going through now. Do you know what the asset will look like in 5-10 years' time? And if you're still comfortable with that, then you keep it. Doesn't matter what Mr. Market does. And if it gives you an opportunity to buy that very good asset, and over time the information's got even better, and it's actually made the investment case even stronger, you add more. And I think what you've got to do though is when the facts change, you've got to move fast. So we did that on Tsogo, which was a casino in South Africa. The house thought it was cheap and it had come down a lot. And I said, no, I think we need to get out of these better ideas. And I think you'll see a bit of that all the time. You know, we'll be more active in that respect. Instead of when you've got the whole world to invest in, rather take some of that dead money and take it somewhere else. You know, there's this psychological thing, I don't know what they call it, but you kind of drive your car through the rear of your mirror. It's not a good idea. Rather look through the windscreen and you get rid of the weeds and not the roses.
Let's definitely talk about some more weeds and roses. But Walter, I guess a theme that has come up a lot, you know, both now today when you're talking as well as previously when we've had many discussions, but just that downside protection and how important it is in terms of the way you manage the strategy. And it's so central to Bravata's philosophy, right? Like the cash generative businesses that you invest in, you know, related to that moving into cash, as you mentioned as well, when needed.
And also the high dividend yields that are coming out of these. The dividend yields on this fund are very high. In fact, this was our best year as a house, where our portfolios were generating yields, our equity portfolios, the dividend yields after costs of 6%. That's quite remarkable, and it goes for Bravata. So I think that does offer you some protection, you know, where you start off with 6% in your pocket. And then also, when you buy unloved assets, like tobacco, casinos in Macau, or alcohol companies at the moment, no one wants to own them. So the risk of overpaying is not there. And when you do get volatility in those sectors, you're adding into them, and then one day you get a surprise. So we're now out of all our oil stocks. You know, we've made our money in oil. I didn't know there was going to be a war in the Middle East.
Yes,
but
well, I hope you didn't know.
But the assets were just too cheap. You know. I'm thinking of Total and Shell and Conoco. Of course, we always sell too soon. But
better than being greedy as well.
Yes. We are greedy when people are pessimistic, and we are fearful when people are very optimistic. That's the best way. This is what you get in this fund. So that downside protection, you can only get downside protection if you've got cash, and it must be good cash, not a bank that's going bust.
Yes.
But in general, I think it comes from not overpaying. I think it buying assets that no one wants to own. Not as an in-value investor, but they want to buy the sexy 7 or the magnificent 7 in the States. Or they don't want to buy British assets, whereas we were quite big into British. No one wants to buy tobacco for ESG reasons, and we just think that was overdone. And if you think of what's happened in oil, you know, so I think that's how we've managed downside protection and the willingness to own cash.
I mean, interestingly, you mentioned about ESG reasons. I mean, no one wanted to buy defense for ESG reasons, and now everyone wants to buy defense for ESG reasons.
Human beings are the same. It's just, you know, they're never going to change, and it'll, you know, the history will repeat, but it will just rhyme differently, as I think Mark Twain said.
And Walter, I guess just from a regional allocation perspective, I mean, you've always been very independent-minded, and you haven't said, like, this is the benchmark, so you're going to stick to that. You obviously very much, you know, you care about your investors and making sure they have absolutely the best portfolio positioning. And as you've alluded to, you're still very constructive on South Africa relative to the US. And I mean, that's quite a good call, I think, at this point. But where are you seeing the most, like the best, most attractive risk-adjusted opportunities at the moment?
Look, it's very difficult to have a view on the world. You know, you need armies of people to look at the world, to be an expert on where to play and which market and which sector. I don't believe I can do that. What I can do is say no to a lot of things. And then when I do like something, I can say to an analyst, you're the chocolate expert. Which chocolate company can we own?
I mean, I'm also quite a chocolate expert.
Yeah, but what's amazing is that if you look at the cost of cocoa, which makes up the cost of sales of chocolate, has now dropped dramatically. There are not many pure chocolate companies that you can invest in, but we found one, which we bought 5 years ago, which is listed in Singapore, but is an Indonesian company. Went up and then went down. We didn't sell it. It's been giving us a fantastic dividend yield. We did not know cocoa prices were going to go through the roof because there was a shortage. Now the cocoa price is abundant and the cocoa stock. The share price is now starting to appreciate again because it reflects that cost of sales is just dropping. So we will then go and play there. But it's Indonesia, it's a high risk region. It's got dollars on its balance sheet. It's listed in Singapore, so there's an element of good oversight there from the stock exchange. And we're getting magnificent dividend yields in the meantime. Owner managed, second generation. We'll put 3% of the fund in there. And that's what's the beauty of looking around the world. The States won't go away. It will always be a very interesting opportunity. But I cannot help thinking that what has happened the last 20 years, and not necessarily the last 12 months, there's been a gradual erosion of the things that we admired about America, the USA. And I do think that countries like in Asia will reward you more. They're go-getters, they get on with it. If you think of what's happened now, the way they've adjusted to this multipolar world that we live in, where we had one superpower, now we've got lots of regional superpowers. I think I would rather face east than west.
Definitely makes sense. I mean, Walter, just moving forward to your outlook now at this point, it does remain volatile, but that volatility does create a lot of opportunity for you in the fund. Whether it's mean reversion, valuation dispersions, I mean, all of these things tend to favor more patient and disciplined investors, which we very squarely fall into that camp. But what would need to change materially at this point for you to either become more cautious or more aggressive in your positioning?
Well, I'll tell you what does worry me, and it's worried me or concerned me for many, many years, is that the cost of money is rising, and it's been rising for quite a while. And not much attention has been paid to this, except for a few very good investors where the cash is piling up on their portfolios or their businesses, such as Warren Buffett's one, and a few other savvy investors. They're not calling the market. We don't think there's going to be a crash. But I think governments over the years have hijacked the bond market. They've pushed their borrowings way too high. And as a result, inflation is starting to pick up. And asset inflation has been there for years. Everyone's into property. Everyone has a second or third property. And there's a problem in the world that young people can't find residential properties to stay or own. So I suspect that we will go back to the norms of the 70s where you had high inflation, cost of money went up, and we've been spoilt. Buying the dips mentalities were going to come back and bite you. And the peace dividend that we enjoyed for the last 50 years is over. And some of the damage that's been incurred the last 14 months by the President Trump and his government, it's not going to go away. It's not going to disappear. It takes years to mend those broken bridges. So I can't help feeling history will repeat, and it's going to be tough times. So we are trying to buy the predictables, which is, we think, is tobacco, we think alcohol, casinos, good industrial companies. AI we haven't even spoken about. It's out, the genie's out the bottle on that one. We just can't put it back, and we don't know what effects that will have. I suspect it will be very positive. But we cannot continue disrespecting money, the cost of money. And I suspect we'll get a washout, a very painful one. And those assets that survive will do well. So that's why South Africa is attractive. Because if you think about it, in the Greek economy, they went through a big washing out phase. And it's very painful. We've had to stop borrowing money as a government, and you can see what happens. And there's no one backing you like the EU, the ECB backed Greece, and we've got the US that really was the banker to the world. If you think of Airbnb and you think of Uber, the taxpayer in the USA funded us. That's over. So I'm more concerned about, I think we should be getting ready for 5 to 10% returns per annum maximum. I think the good days of 20, 25 are over.
Yeah, but I think it's fantastic that if you look at the businesses that you've been invested in, quality businesses, strong cash generation, and attractive valuations. And I think that's definitely one of the hallmarks of Bravata's approach.
And I think we would be 100% South Africa if the custodians of our economy acted like custodians, true good custodians. We're only 30%. That's not a big play on South Africa. But this is our back garden. This is what we know really well. And there's some very good assets in the hotel businesses that we're in South Africa. And Oceana Fishing is a very good business. Boxer, which is a retailer, up and coming. We Buy Cars. These are South African businesses. We're not trying to copy the rest of the world. In fact, if you think of what Capitec did for the banking world, we're hoping that We Buy Cars will be for the second-hand world, car sales. And Boxer's taking market share from other retailers. So I think in that respect we'll be fine. And then when the banks got really cheap last year, it was ridiculous. The divvy yields were higher than almost as high as the bond yields. And that gap was wide open. And we bought a lot of banks for the fund, and we've sold them already. So that's where we want to be a little bit more aggressive in the fund. And we know South Africa. We don't own banks today in South Africa. There's nothing wrong with our banks, but the easy money was made.
Walter, thank you very much. That was excellent and a very insightful discussion.
Pleasure. Anytime. Thank you.